Thank you, everybody, for being here at the DNA House in Paris. We are so excited to welcome you. We have our third panel of the day. This is largely going to be about the RWA market and why it's important. We have several esteemed guests up here who I'd like to do introductions. But first, I'll introduce myself. My name is Jake Flaherty. I'm with the DNA advisory team. I also run the deal desk. And I've been with DNA for about a year, Web2 background, and I own and operate a couple of boxing studios. So if anyone wants to talk boxing, come find me. This is actually not Nick. Nick is stuck in an airport. So this is Adam, who would like to introduce himself.
Yeah, sure. Thank you. Yeah, I do apologize on behalf of Nick. He's stuck in Greece because there's a strike there right now. So all the planes are not going anywhere. I work directly under Nick at Zodia Markets. We're a stablecoin brokerage. What gives us a unique position is that we are owned by a tier one bank. We're owned by Standard Chartered. So that gives us a lot of interesting strategic advantages when it comes to working, especially with stable coins. And my role is partnerships within Zodia Markets, and I've been doing this for a good 3 or 4 years now.
Thank you so much, Adam. And Jacob, go ahead.
Hi guys, my name is Jacob. I'm a co-founder and CEO of Solid Protocol. Solid Protocol offers crypto investors passive income strategies on stable coins, and the income is generated based on the real world assets. So that's why I'm here probably.
Very good. Hi folks, Eran Barak. I lead the Midnight Initiative at Input Alpha, soon to be its own entity. Midnight, for those who don't know, is a blockchain that offers privacy for transactions and assets.
Amazing, thank you. I'm assuming everybody knows, but just to make sure we are all on the same page, Adam, if you could give your best definition of tokenization and how you think it's going to affect the world of finance moving forward.
Yeah, of course. Best definition. Can I just get ChatGPT out on my phone and use that? Because it'd probably do a better job than me. No, my perspective is very much laser focused on stable coins. So obviously stable coins are backed by usually fiat currencies. I think 99.6% of the stable coin cap table right now is all USDC, USDT. So it's all US dollar backed. So for us, what we see is a lot of tokenized assets that are backed by US dollars. What's really interesting is US dollar banking is getting harder and harder to access. A lot of my clients are in emerging markets that are difficult to access real US dollars. So being able to access a tokenized US dollar is a heck of a lot easier. So I guess in its simplest form, that's what it is. It's making it easier to access and trade and deploy a real world asset, even something as simple as a US dollar.
Awesome. Jacob, if you want to just kind of detail how your company is approaching Soil, how Soil is approaching the RWA market and what impact you're making.
Sure, but I would also add some thoughts about
Please,
what is the perfect definition. So for me, the definition of RWA is making liquid something that was not liquid before and accessible to the regions that was not accessible before. So that's how you can tokenize different assets and put it on chain and make it accessible and liquid 24/7 for everyone. So what we are doing, actually, that's exactly what we are doing in a Soil. So we are offering stable yield that is generated there, but mainly by the private credit. If we are in the European Union, if you want to invest as an individual in a private credit fund, the minimum ticket is $40K. And getting onboarding is quite long and it's not accessible to everyone in the world. So let's assume that thanks to the fact that we are offering this kind of products to the people that are active on chain. So right now, even in the unbanked regions, without the minimum ticket, you can access Soil and get the access to the institutional grade finance very easily and very seamless. So that's what we do.
Aaron, if you want to go ahead as well.
Sure. I actually like Jacob's kind of comment about liquidity, because if we use, say, an example of real estate, where it's very hard to get liquidity, every transaction requires a lot of paperwork, a lot of intermediaries, insurance, because there's a very high valued asset that you want to transact on. Now you need all these steps in between to get a transaction done, and it's like it's all or nothing. You can't just fraction, your house or some asset in order to sell a portion of that. Tokenization cannot just provide that liquidity, but kind of streamline the entire process and allow for more division. The challenge that we see, the challenge that we see is that current blockchains, while they enable that, they're completely transparent. So every transaction of everything is completely visible for everyone forever. That's probably not the framework that would allow transactions of real world assets where you need to protect what is actually happening and keep some privacy in place.
Sorry, I was so eager to jump in there. You were talking about liquidity, and I have a use case that I think it's the best use case for tokenization. So a few years ago, I founded a company which was tokenizing Scotch whiskey casks. So, and Scotch whiskey is obviously, it is literally a liquid, but it's a very illiquid product. Like, it has to sit in a cask for at least 10 years in a warehouse, and it's a nightmare to move. So tokenizing it was an obvious choice. We had a Macallan cask that was about 30 years old in the warehouse, and it was valued at just shy of literally $500,000 for the cask. Finding a buyer for a cask like that was a nightmare, but we fractionalized it, literally chopped it into $1,000 chunks, and it sold like hotcakes. It was so much easier to move. So yeah, I just love that example.
Yeah, but I think that is quite important thing that sometimes people do not remember is that even if you get a real world asset and you will tokenize it, let's say this whiskey, it doesn't mean that some kind of risk disappears. You still need to have a storage, you need to have an insurance and all this, let's say, administration around it. So it makes you liquid, you can sell it, buy it, accessible, but still the real world risk exists and do not change at all.
That's a fair comment, which is why what we're seeing is that digital assets like music rights or other IP are probably going to be the first types of assets that are going to find themselves into RWA because they're the easiest one where there's no storage or other physical element of custody required.
I actually have this question for each of you guys, but from an investor perspective, what differentiates a good investment for RWA versus something that you would stay away from?
That's it. We could talk all day on that question. I think that's a really good question. I think you touched upon it right now. Like, it's really in both the comments that you guys made. It's what makes the most logical sense to tokenize. How is the risk managed? Like, going back to the whiskey example, what was really useful about tokenizing whiskey and what made it work is that it's a very regulated environment in Scotland anyway. So everything had to be tracked already. Everything was already logged and backed up and insured and kept in a safe, regulated environment. And you need a license to be able to deal and handle that product. And what we were doing is just literally segregating that and let the professionals do what they do best, and taking the marketplace for it and making it really easily accessible. So it connected really nicely, but where you have unregulated environments, where you can't track and insure and protect your investments, or where there is an advantage because it's not a physical product, it's a digital product, they're the opportunities that make the most sense. But I think the last 2 years in the industry, we've seen just about everybody tokenize or try and tokenize just about everything. And the ones that make the most sense are the ones that take off.
Thank you.
Yeah, so I think that let's say, due diligence process for the investment is exactly the same. But we need to add one factor who is responsible for the process of the tokenization. But if you are an investor and you are looking for some rate of return, and you are looking for some alternative investments, let's say whiskey, or I know uranium. Yesterday I talked to one guy that they're approaching to tokenization of the uranium just to minimize the ticket and make it accessible to other investors. So you still need to have a due diligence of the underlying asset that is tokenized. The normally whether it is real estate or wine or whatever else. There were some projects that were tokenizing some, let's say, carbon digitalization of the carbon farms in Egypt. There were some projects that were financing some exotic investments in South Africa. And all these investments collapsed, even though that it was put on chain and was tokenized and offered quite attractive yield. So from my perspective, it's actually the same process for the analysis of the underlying asset and what kind of investment it is. And there is also, as I mentioned before, so the risk is almost the same. Yeah? So it's not disappearing because you are putting it on chain.
I think my colleagues already covered what I had in mind. I will just add that we forecast anywhere between 10 and 15 trillion dollars of assets to come on chain in the next 5 to 7 years. That's an unfathomable number. And if you're thinking about investors, they are looking for the blockchain as a vehicle to actually enable the fractionalization, the liquidity, and the access. But he's right. It's how can you guarantee the right collateral is there and kind of is managed properly. The beauty of a blockchain, unlike a paper contract, is it's enforced through a smart contract. So you've got a much stronger enforcement of the rules, and the other party cannot just abdicate of things. What I think is still missing, and that's why we are, I'd say, working with folks like these, is kind of the infrastructure to make that future another reality. And we hope to bring some of that in the upcoming years.
I want to remind you what happened last year with the USDC. And they tokenized one of the biggest projects, tokenizing dollars. And then it turned out that exactly 8% of the reserves were kept in the Silicon Valley Bank. And over the weekend, we had a debate exactly on 8% because there was a threat that the collateral will disappear. So even though that you got a, let's say, stable point that is not risky, because you got a US dollar that is backed by the treasury and audited reserves. And it turned out that over the weekend you could have a 10% less, almost 10% less. So approach is exactly the same and the risk is still in place.
I got an interesting one. So you wake up tomorrow, 10 years later. What % of your portfolio do you anticipate being invested into RWAs? Go ahead.
What do you guys want?
Go ahead. Aaron, you can start.
First of all, I think that there will be no RWA at all. We will have just assets. Because it's funny that we are saying that something is real worth assets. So it means that on the blockchain is not real. So it's I think that we will tokenize more and more assets, and we will it will be asset class put on chain. That's it.
I agree.
And the percentage, I'm not sure that it will be 100%. I think that it will be something around 20+%.
I think much higher. Well, it depends on your personal situation, but today when my assets are invested through a bank or a wealth management, I don't really know what's the underlying kind of assets or instruments that they're being invested in. And to his point, everything will be kind of assets being digitally managed or in some way. It's the same as today we have DeFi and TradFi. In a couple of years, it's just going to be FI. It's all going to be one. So I think that if most of your investments through pension or any other funds will include RWA and other things in the mix, like everything else, they'll just be assets being invested.
I think putting a different spin on it and looking at it through like a corporate lens, and we were talking about this just before the panel, where at Zodio we're moving about $200 million a day through stables. And at the minute, we're working with a lot of the big oil companies, shipping companies, port authorities, to really move a lot of that industry into stables because it makes a lot of sense. It's an industry that really struggles with slow, terrible fiat rails. So looking at it at the corporate lens in 10 years' time, the volume of assets that these guys will have in tokenized, whether it's US dollar backed or anything else, I mean, the market cap for these industries are measured in the trillions, like you suggested earlier. So as soon as that adoption really starts to ramp up, the volume moving through tokenized assets. I mean, you mentioned several $1 trillion earlier, and I think that will happen very, very quickly. $200 million a day for us is still very, very small compared to what the oil companies move daily.
Tiny. I think we're going to see a lot of, well, let me take a step back. The industry as a whole has been at odds with regulators for the last couple of years. It's really challenging. Um, it's natural for innovation to kind of push the boundaries and have regulators kind of catch up. And the way they've kind of tried to mitigate the risk is by not regulating, just being a little bit silent. Every country, the US especially, therefore businesses and thinking about RWA and tokenization have been cautious to enter into the market. Now with the new Trump administration, what they're doing is putting some of the guardrails, and that's going to reduce the risk of doing business, and we will see a ton of capital, institutional kind of move into the market, enable applications, start introducing RWA, and allowing that to actually get into the market with real pension funds and other funds investing in these type of assets. So I agree with that for the next couple of years.
Yeah, but we also need to analyze what's going on right now. So we are tokenizing, let's say, US dollars, issuing stable coins, and then we off-ramp the stable coins and finance, let's say, treasury bills, or trying to invest in a real-world asset. So it means that we off-ramp and it's going out of the system. So actually, right now, this is a great blockchain. Is mainly a great place to get the alternative source of the financing, but for the old economy, let's say, or traditional economy. So that needs to change. We need to have a products and companies that actually generate tangible yield or tangible businesses operating on chain without interacting, let's say, with the real world assets or real world at all. So right now, what we've got, let's say, Uniswap. Yeah? So Uniswap is, let's say, DeFi offering selling tokens, exchanging tokens, and so on. That's how you generate actually 100% generating and operating business on chain. This is a unique because it's only used for the exchanging tokens. If we will find a business model that can exist only on chain and bring the value, not the value, generate the value only on chain, that when we will talk about the adoption and essence of the blockchain. Right now, I see that a bit different in a bit different way.
Do you anticipate over the next 5 years, I think everyone can agree there's going to be an absolute RWA takeover. Do you feel that it'll be a bit of like a space race where there will be a few companies that end up taking up the bulk of the market share in the ending? Or do you feel that this is something where RWA companies can partner together and all boats rise together? How do you anticipate the market to look? And Aaron, we can start with you.
I'd like to think it will be more decentralized. There's really no, thanks to the way the blockchain is built, there's no economic advantage for centralization, such kind of practices. If you have, let's say, music rights and you want to get royalties out of tokenizing that, why would you go through another intermediary if the blockchain can offer you direct access to people who want to get that yield, to your point? There's really no reason for centralization. Now, it could be that there are going to be some big players that would streamline some of the smaller kind of the type of assets, and you're like as a user or a holder of some assets, go like, I don't care if you work on this and I'll just go through some exchange or intermediary. Sure. But for the bigger kind of plays, they'll go directly to market.
Yeah, I agree with you completely. I mean, again, looking at it through our lens, there are other organizations out there that do exactly what we do, brokerage, stable coins, and we don't see them as competitors. We actually work very closely with a lot of them. There's always, you work with a client to get them live and trading with you. And then, after months of working with them, you find out there's a blockage somewhere and it's just, you can't overcome it. So it's good to have friends in other places that I can say, hey, we can't serve this client, but I'd love to pass it over to you and vice versa. And then we can make the trade flow work around that. So if one player arises and takes over all of it, then but it would be a shame to not have that element as well. So yeah, I think it's good that there are multiple players out there doing what we do. It's good to not have the competition, but have the friends.
Completely agree. Market will be competitive and it will be for good for all the participants.
How are each of your companies, what are they doing to attract TradFi investors? So how are they getting them comfortable with the investment? Because obviously the name of the game of growing the industry is pulling over the TradFi investor. So how is your project specifically making an impact?
Well, for us, it's about making the unfamiliar familiar. So being owned by Standard Chartered Bank, what we do is we copy paste a lot of the bank's compliance and regulations and the way that we operate, so that when we're interacting with traditional finance institutions, it all feels very familiar with them. When we're offering stablecoin brokerage, when we offer spot trade, we basically put the spread into the trade price, which is how FX operates. So these guys are very used to that business model. There's no hidden costs for them anywhere. So again, it's just making them feel comfortable with something that they're already familiar with. When you move a little bit further away from the hard finance side of it and into more of the corporate world, that's where they tend to get really kind of nervous about words like crypto and digital assets and stable coins and things. That's where we really need projects like Midnight to come in and make it, make it comfortable, maybe take some of the work and the risk out of their hands and help them access other players that can help them manage that.
So for us, it's first of all offering products that are not available to the retail customers. So as I mentioned at the beginning, so there are some, let's say, institutional grade finance that are available to the less wealthy clients. And thanks to the fact that we can, let's say, democratize the access to this product, we can offer literally everyone in the world a product that were not available to them before, without the minimum ticket. So that's the one thing, especially for the unbanked regions and regions, for example, like we've got a lot of customers from the Turkey. When there is a high inflation, people are looking for the financial products when they can hedge against the inflation and be sure that they're getting money because of the valuation of their currencies. So offering products that are not available to them before and offering products that they can easily access without the, let's say, long administration, without long onboarding process. And again, that's the best offer for them. So showing the USPs that we are offering.
I'd say we believe that blockchain is a beautiful thing, but TradFi looks at it and goes, that's not ready for what we need. I'll give you an example. Banks are kind of subject to various banking rules. You've got GDPR that requires kind of the right to be forgotten on retail, PII data. How are you going to create a TradFi application, even retail for RWA, when the blockchain is completely public and never forgets anything? You're in violation of regulation right there. We have to evolve blockchains to have the ability to protect data and offer privacy. So what we're doing at Midnight is enabling that and enabling also things like predictable kind of expense or predictable cost on using the chain, which is again preventing use cases from actually coming into life. Until we evolve blockchain industry as a whole to enable data protection, privacy, cost control, SLA, banks will look at our technology and our industry as a, we'll get there someday, but we'll not cross the chasm. I think we're ready to actually make that cross, and that's going to unlock all that potential of RWA. Nobody wants to have all their transactions in RWA completely transparent to everybody else in the world. Neither the sellers nor the buyers. We have to enable some level of privacy and selective disclosure on what you want to offer and show. Then this market will start thriving.
We briefly just touched on it, but I'd love to go more into how you anticipate the regulations, the regulatory environment to change over the next few years in ways you think will help the industry, in ways you think may hinder the industry. Jacob, you can start.
Yeah, so I do believe that The first wave will be regulations that will make a massive wave of the stable coins. So this is because stable coins are the backbone of the economy, of the blockchain economy, and so on. So we need to make it available, accessible to everyone. And that will, in my opinion, will ignite the spark and will be a trigger that will put the market into more and more adoption. So stablecoins and the regulations that will make stablecoins available to everyone, and that we can simply everyone can use a stablecoin that will make transactions easier, faster.
I'll go. Okay. I believe that we're in the next 2 or 3 months going to see a stablecoin bill in the U.S. that will kind of provide some structure. I think after the summer we'll see a market structure bill that will provide further kind of crypto guardrails. Once you have those in place, industries are going to get comfortable with taking kind of the next steps and getting this uncertainty that we've lived through. The previous administration just meant that traditional businesses and other players just didn't feel comfortable enough getting into our industry. In the next 6 months, that's going to change. I know we're seeing a bear market right now, but my prediction after the summer, things are going to get hot.
I guess the only thing for me to add to that is there's a really frustrating thing going on with MiCA at the minute, which under the MiCA regulation, traditional banks who hold assets on permissionless chains get huge financial implications off the back of that. So on one hand, we're trying to make regulation that improves innovation, but at the same time, the same regulation is literally hampering the innovation, because they're never going to go on permissionless chains when there's huge financial implications of doing it. So again, whether we offer more innovation towards permissioned chains rather than permissionless chains, then fantastic. But at the same time, we need less contradiction within the regulation. That's what we need, I think, is really important.
What piece of infrastructure do you believe needs to be built here in the next few years? What are you waiting on for this to really take over and control all of the assets?
Nothing. Midnight is here.
For us, there's an organization that's trying to connect all the different fiat banking rails together. And I think there's 160 fiat currencies globally. They've been doing this since 2002. And I think so far they've connected, 14 chains, 14 fiat currencies. So if you carry on at the same pace, that's going to take 200 years. And I think it works out at 16,000 different connections when you have to connect every 160 currency out there. So obviously that's not the right answer. So the whole reason for us behind stablecoins is that you don't need all the fiat currencies to be connected directly. You use the stablecoin and then you instantly have that connection. And at the minute, something that we would really like to see, and I think this touches on what you said earlier, is not just the stablecoin sandwich where companies on-ramp move money and then off-ramp. So we're trying to build an FX market for stablecoins where businesses, corporates are literally trading one stable asset for another stable asset, and it stays on chain rather than just stablecoin sandwich on and off. So we'd be excited to see more of that. We did the first few corporate trades from Australian stablecoin backed dollar to US stablecoin backed dollar between companies recently, and that was really exciting for us as a starting point.
I'll give a more serious answer. I think one of the hampers right now is the fragmentation of the blockchain industry. If you're going to digitize some assets, which chain are you going to put it on? Gets kind of locked into that ecosystem, because ecosystems are not compatible or interoperable very easily. And that's a decision that is troublesome, because later you may kind of get into trouble. So sure, you can wrap and tokenize it elsewhere. It just gets overly complicated. I think one of the trends that I'd like to see in the upcoming kind of period is more of a collaboration across the industry that would kind of reduce kind of the risk and friction for RWA consideration to come on chain because they're not going to be locked into any ecosystem.
Aaron, Jacob, Adam, we are out of time. So thank you so much for your insights. It was really great to talk to each of you. And I hope you guys have a great night. Thank you so much.
Awesome.
Thank you.
Thanks.